Hello everyone, my name is Cameron Stevens and I'm a real estate agent in Los Angeles, and I'm here to make a video today about why owning a house is not the best return on investment that you can make. Why in the world would I do such a thing? Well, the fact of the matter is that there are actually better investments, but I'm going to show you exactly where I believe real estate falls on that list and why most people choose to ultimately add real estate to a part of their overall investment portfolio. So let's just start from something really high level. Owning the house that you live in by itself is not actually the best return on investment that you can make if you look at it from just simply an annual appreciation. Just speaking historically, the return on investment for homes nationally is somewhere around 3 to 4%. And the forecasts for this year, considering coronavirus and some shakiness that's in the stock market, people are putting it somewhere between 0.5% and maybe 1.5%. So things are starting to slow down on the real estate front. So let's put a pin in that. Let's go into some other areas of investment that I personally believe are in better return on investments and things that you should probably consider before purchasing a house. So the first thing is actually investing in yourself. This is actually not a percentage return, but a multiple return. This is the only investment, in my opinion, that you can actually get potentially over 100 times return on your investment, maybe more. I mean, the reality is that number is not infinite, but it doesn't really have an actual ceiling. By investing in yourself, you can potentially get returns that are just unfathomable. Now, what do I mean by investing in yourself? That could be as simple as an investment book. That could be an entrepreneurial book. That could be a book on personal finance. Say you wanted to get into software coding, a simple couple dollar book, or even potentially a free book that you get at a library could have 100 times investment if ultimately it's something that you increase your income. This also includes things like watching YouTube videos. I mean, to be honest with you, you can just learn insane amounts on YouTube right now for zero money. Well, I mean, not zero, the cost of an internet connection, but the return there is incredible. Everything from learning how to fix something so that you could save money on repairs to learning a new trade, learning a new skill. The investment in yourself is unmatched. So let's go to the next tier down. That is investing in a business that you own and run. Usually the investment returns on that are somewhere around 10x, maybe a little bit more. This is you starting your own company or working with investors or having a business partner and creating something new from nothing. This is one of the places where there's usually a cap on that return, but it is potentially in the multiples. There are very few other investments that you can do 10x plus return on your money than investing in your own business. But it's something that you need to have investment, and you need to have a hand in it to get that kind of return. Now let's go down one more ranking. This is where I call high yield investments. So this is in the percentage of return on your money. This would include investing in a business that you don't run. So maybe this is something where you are investing in another entrepreneur, another business, another startup, or something like that. There are other high yield investments are out there that can return over 10% annually. Many of them are actually only accessible to high net worth individuals, accredited investors, because they tend to be riskier. Obviously, the higher risk, the higher reward. There are funds out there that can decently reliably return a 10% on your investment. This is not for the casual investor. Most people do not do this. This is like I said, this is for accredited investors, and that is actually a specific legal documentation that you would need to do to get the ability to invest in these types of things. However, obviously, if you wanted to become an investment partner in somebody that you know that's starting a company or something like that, that you can do relatively easily. You don't need any designation for that. Let's go down one more notch. A diversified mutual fund stock portfolio. So this is pretty much just stocks, or maybe stocks with a little bit of bonds mixed in. This is not your retirement account. A retirement account is going to be it's going to be a lower rate of return, but it is going to have a higher mix of, probably higher mix of bonds in it. So if you just threw everything into a low-cost index fund, say the S&P 500 or something like that, historically that is going to return somewhere between 5 and 7% annually. Now, obviously, we know that stocks have been volatile this year, and that is an average rate of return. That is something that I would minimum 5 years, preferably you want to keep your money in there for 10 years plus. And then that way you can ride out the highs and lows that inevitably happen in ups and downturns in the market. This is not money that you should be accessing. You can pull from it if you need to in an emergency, but it's not something that you should be on the short term investing in. So again, that's 5 to 7%. Now we get into real estate. Like I said, real estate on average returns somewhere around 3 to 5%. Now, if you've looked at Los Angeles prices, say in the last 10 years, you are going to find a very different story. You're going to find numbers that are much, much higher than that. In fact, in some areas, you are going to find double-digit increases. As somebody who is looking at this on their primary residence scale, that is not what I would expect to return on the long term. It's something you can return, but real estate does go through its cycles as well, just like the stock market. So, what would make real estate a interesting and actually a good addition to your overall portfolio? Well, the first thing is you do have to run your rent versus buy calculator. Owning a house is expensive, purchasing a house is expensive, and selling a house is expensive. There is a lot that goes into that process that people don't always think about, and there absolutely is a cutoff where if you don't own your house for a particular length of time, it actually does make more financial sense to rent. That cutoff is somewhere, it's been going back and forth in Los Angeles. It kind of fluctuates a little bit, but it's held pretty steadily around 4.5 years. So if you're not planning on living in your house for more than 4.5 years, I like to be on the safe side and just say 5. Then I would say that you should continue renting. I mean, maybe if it's you don't know exactly if you want to stay in this particular city. Maybe you don't feel stable about your job, or maybe you think that there's some bigger changes that might cause you to change your living situation. In those instances, you absolutely should rent. However, if you know you're going to be staying in your house for 5 years or more, you like the area, you think that this is a place that you will be long term, there's a couple of reasons why real estate is really, really excellent as a part of a portfolio. So first of all, there's tax savings. And most people, as they start to get further on in their careers, in their investments, in their portfolio, they switch to itemizing deductions. And in this instance, you can, a lot of people know this, but you have property taxes, that's state taxes, that is county taxes, and there potentially are local taxes as well. All of those property taxes are deductible. And then your interest payments on a mortgage, those are also deductible. Also, in addition to that, if you pay any points on your loan when you get it up front, those are actually tax deductible, but that's just in the year that you actually purchase the house. As people start to earn more, they start to look at ways that they can save on taxes, and owning your primary residence or real estate in general is definitely one of those ways. Additionally, when you go to sell the house, you are able to have 0 capital gains taxes up to $250,000 in gains for a single person, and for a joint filing, married couple, it's up to $500,000. So if you are doing work on your house, if you want to renovate it, you want to invest in your house, you are not able to deduct those expenses. However, what the government does is they are going to allow you to essentially take that tax deduction on the sale of the property, considering the increase in value. Now, we're talking up to $500,000. That's a lot of money in capital gains tax savings, which hovers around 20%. Now, I will be the first one to admit that there are some instances where if you rent at or below market value, and you have a certain percentage of your income that you diligently invest every single month or every single time you get a paycheck in the general stock market, that you can come out ahead. However, most people just don't do that, okay? You have to be extremely diligent, and if you're missing any of these investments on a regular basis, you throw the whole calculation out of whack, and it may certainly become no longer the most profitable option. Number two is most people, generally speaking, they need a place to live. So in this way, I like to think of real estate as a forced savings account that gets a pretty decent rate of return, because you have to pay your mortgage payments every single month. Now, investment in real estate tends to trend differently than an investment in the stock market. It tends to hedge against inflation, and it tends to be far more stable than the stock market. So in that instance, even though the returns aren't as great as the general stock market, it can actually be a great place to essentially defend yourself against ups and downs in the stock market. It's something that on its own is maybe not the most high yield investment. However, as a part of your overall investment, it leads to additional diversification, which raises the return on investment of the portfolio as a whole. So that is why a lot of people really like real estate, because it actually trends slightly different than a lot of their other investments. It hedges against a lot of their other investments, and you get to live in it. And so for most people, they're going to say, okay, I want to incorporate this because I'm going to get additional uses out of it besides just the overall investment, return on investment. I can live in it, I can renovate it, I can hold it long term. It's something that I'm semi-required to have, a place to live. So why not go ahead and incorporate this as a part of my return on investment? So that is why most people invest in real estate. It is not because it yields the highest return on investment, but instead it offers many different advantages, and rolled into the whole, it tends to perform quite well. Now, what performs a little bit less than real estate? Okay, so these are going to be things like different types of bonds, treasury bills, some people call them T-bills, municipal bonds, munis, corporate bonds. These are very stable investments, but because of their stability, because they're guaranteed, their investments are somewhere between 1.5%, maybe 3% on a long term. But these are things that you're going to be holding for 10 years plus usually. They're very, very stable. They're things that people incorporate as a part of their retirement portfolio because they are super, super stable. Below that, you've got high yield savings accounts. High yield savings accounts used to actually return somewhere around 2.5%, maybe high 2s. Interest rates have absolutely plummeted recently, and they are at historic lows. So high yield savings accounts are somewhat non-existent at this point in time. However, they still offer a decent return on investment. I have a high yield savings account that's trending at about 1.5% at the moment, which is not crazy good. However, if you compare it to a typical savings account, check your typical savings account from like Wells Fargo, Bank of America, Chase, or something like that. You'll probably be sad to find out most of those return at like 0.01%, which is why at the end of the year, they're like, congratulations, you earned 2 cents. Not really worth it. That investment is essentially close to zero. And what is lower than that? Well, okay, so not necessarily lower, but sort of in their own category, I like to think of it. People are going to be like, well, where do cryptocurrency or day trading or penny stocks or junk bonds fall on the spectrum? Some of those yields can be crazy high. Yeah, but you can also lose everything. So all of those things that I mentioned, cryptocurrency, day trading, buying individual stocks, buying and selling individual stocks, buying options, investing in like penny stocks and junk bonds of things like JCPenney that recently went bankrupt. Yes, you can get a fantastic return on your investment. I am not a Vegas person. I don't like to gamble. That is basically gambling. Most people will straight out tell you it absolutely is gambling. And in many cases, people will say, hey, you probably get a better return on your investment going to Vegas and putting it all on red. So those are investments that are just like, for me, they rank lower than like your crappy savings account. So there you go. I know this is a long video, but I really wanted to give people a perspective as to where real estate actually falls, and also give people the reality of what its return is compared to other different things, and as well why I like to make sure that it is a part of a well-diversified portfolio. If you have any questions, if you agree, if you disagree, reach out, let me know. But this is my opinion on it. Also, small disclaimer: I'm not a certified investment broker. I'm not a tax person. I can't advise you on any of that stuff. So don't take this as advice. But this is what I personally believe. So thank you for watching.